Hi, I'm going to talk to you today about taxes and how they can potentially impact your investments. And I'm going to do so using the graph that you see in front of you. It shows the growth of a Canadian stock portfolio over the long term. Here I'm using the S&P TSX Composite Index, and the growth per dollar invested in it is shown in the dark green line on the very top. And you can see $1 way back in 1970 grows in an uneven fashion up to just north of $50 by the end of 2014. Now that's pretty good. However, it doesn't include any taxes or any fees, which both come into it, of course. Now I talked about fees a little bit in my prior video. This time I'm going to focus in on the taxes, and I'm going to assume a 23% capital gains tax rate that's levied annually on the index-like investment. Now that assumes that you turn over your portfolio, you buy and sell everything once a year, which most index investors wouldn't do. But let's go with that assumption. That sort of shows the biggest impact that this tax rate can have. And the result is shown in the solid red line that grows up to only just north of $20 by the end of 2014. So that's quite a hit over the long term. You turn a portfolio that would have gained just north of $50 into one that gained just north of $20, a little worse than half off. As it happens, that's also roughly equivalent to having an index return less an annual fee of between 2 and 2.5%. That's an annual fee on assets. And I've shown those in these orange dashed lines that sort of surround the 23% tax line. So I thought that was a fairly interesting observation. But it really drives home, certainly on the tax front and even on the fee front, that you want to reduce fees and taxes where possible and where legal, of course. So how do you do so? You want to opt for things like investing in RSPs or TFSAs, tax deferred, or other tax sheltered type accounts. Also, most investors, thankfully, don't buy and sell their entire portfolio each year. So they don't get that tax hit each year, and they can defer it, and they can grow, like if they have money in a taxable account and they hold on for, say, 40 years, then they don't get that tax hit each and every year. They only get a tax hit at the very end, and that results in some tax savings. Now, naturally, most people fall somewhere in between. Most people aren't holding an investment for 40 years, maybe holding it for 10. But the idea is there, if you want to save on taxes, try to buy things that you can hold for long periods rather than things that you're looking to buy or sell over the course of a year or two. Now, I hope that sort of shows you the impact that taxes can have on your investments. I'm going to follow this video up with another one that sort of brings fees, taxes, and inflation all together into a fairly shocking graph, unfortunately. But until then, be sure to try to save on taxes and save on fees, and I'll see you another day.